Welcome back to The Explainer. I'm so glad you're here because today we are looking at a corporate transformation that is just fascinating. We're breaking down Edgewell Personal Care's recent strategic restructuring. We're going to dive into their Q2 2026 earnings, analyze a massive divestiture they just pulled off, and really unpack the macroeconomic fallout that came right after. Honestly, it's a classic story of short-term pain for what management hopes is long-term gain. Let's get right into it. Here's our roadmap for today. 1. The Edgewell portfolio. 2. The $340 million pivot. 3. The financial fallout. 4. The S&P downgrade. And 5. The path forward. Section 1. The Edgewell portfolio. Okay, so let's establish a baseline of who Edgewell Personal Care actually is. Put simply, they're a mid-size, pure-play personal care consumer products company. They're not some massive, sprawling conglomerate trying to do 100 different things at once. No, they are hyper-focused on consumer personal care, and they have a really substantial global footprint. We're talking operations in more than 50 markets: the US, Canada, Mexico, Germany, Japan, the UK, Australia, and they're doing all this with a worldwide workforce of over 6,200 employees. Now, you might not instantly recognize the corporate name Edgewell, but I guarantee you know their products. We're talking household names here. In the wet shave category, they've got Schick, Wilkinson Sword, and Billy, right alongside shave prep brands like Edge and Skintimate. In sun care, they're an absolute powerhouse with Banana Boat and Hawaiian Tropic. And for skin and grooming, they boast Bulldog, Jack Black, and Cremo, not to mention those ubiquitous Wet Ones wipes. So the focus is crystal clear: shave, sun, and skin care. Section 2, the $340 million pivot. All right, now that we know who they are, let's explore the strategic catalyst that completely shifted this company's trajectory in fiscal 2026. And that catalyst is a huge number: $340 million. Back in February 2026, Edgewell completed the sale of its feminine care segment to a Swedish health and hygiene company called Essity. The deal was struck for $340 million on a cash-free, debt-free basis. And look, this wasn't just a simple asset sale. It was a fundamental shift in Edgewell's corporate identity. This really frames the strategy perfectly. On the left, you've got the core business they're keeping: shave, sun, and skincare. On the right, the divested business, feminine care, which included well-known brands like Playtex, Carefree, and Stayfree. So you might be wondering, why sell off these really recognizable names? Well, according to S&P Global Ratings, this segment consistently underperformed compared to the rest of the business. It posted a profit margin of 6%, which really drags when you compare it to the company's consolidated margin of 14%. Management's goal here is aggressive simplification. They're trimming those underperforming legacy brands so they can focus intensely on their core, higher-margin categories. Section 3. The financial fallout. But as we know, simplification is rarely simple in practice. If we look at the second quarter numbers, they tell a pretty complex story. Top-line net sales were actually up slightly by 0.6%, hitting $519.5 million. And they posted a solid adjusted earnings per share of 60 cents. But look at that third row: a total net loss of $10.6 million. Now, a huge driver of that loss is the $37.4 million line item sitting right below it, labeled goodwill impairment. And that is directly tied to the sale of that feminine care business. It's absolutely crucial we understand what this term means. A goodwill impairment is basically an accounting charge, taken when a company realizes that an asset it holds, in this case, the feminine care segment, is actually worth less than what it's recorded at on the company's balance sheet. So when Edgewell sold the segment to Essity, they had to recognize that $37.4 million gap as a loss. Now, it's important to keep in mind, this is largely a non-cash accounting reality of selling off an asset. It's not like $37 million in raw cash just walked out the door today. However, there is real cash walking out the door for reorganization. Edgewell expects to spend roughly $90 million in restructuring and related charges in fiscal 2026 alone. They're consolidating facilities in Mexico, and they're streamlining their North American wet shave operations. In just the first 6 months of the year, they've already recorded over $32 million of these charges. So when you combine the divestiture with this heavy operational restructuring, you get a very messy balance sheet in the short term. Section 4. The S&P downgrade. And you better believe the broader market noticed that messy balance sheet. S&P Global Ratings actually downgraded Edgewell's issuer credit rating from a BB to a BB-. S&P cited a perfect storm of headwinds here: weaker overall consumer consumption, heavy competition in the sun care market that's leading to some margin-eating promotional behavior, meaningful exposure to tariffs, and some past execution missteps. But the real kicker? They're dead. S&P noted that Edgewell's adjusted leverage had deteriorated to 4.9 times at the end of fiscal 2025, which was notably higher than anyone had previously forecasted. Now, this brings us to a really fascinating, kind of counterintuitive question. If Edgewell just sold a segment for $340 million, injecting all this massive liquidity into the company, why on earth are they getting a credit downgrade right after?
The crucial answer here lies in two words: stranded costs. Yes, Edgewell gets a nice cash infusion, but they also instantly lose all the revenue and profit that the feminine care segment was bringing in. Meanwhile, they still have stranded costs. Think overall corporate overhead and operational expenses that used to be supported by that segment's revenue, but which don't just magically disappear overnight. Because of the lost profit and these lingering costs, S&P projects that Edgewell's leverage will remain elevated at roughly 4.5 times in fiscal 2026, rather than dropping below 4 times like the agency originally hoped.
Section 5. The path forward.
So they've taken the medicine, they've absorbed the downgrade, and they're right in the thick of the restructuring. What happens next? Well, Edgewell's management has laid out a highly specific capital allocation playbook to dig themselves out of this leverage position. First up, from that $340 million sale price, they expect to net roughly $270 million after taxes and transaction fees. Second, their immediate priority is satisfying creditors, so they're repaying about $140 million currently outstanding on their U.S. revolving credit facility. And finally, the remaining cash is earmarked to reinvest heavily in their 5 core U.S. growth engines: Schick, Billy, Hawaiian Tropic, Banana Boat, and Cremo. And despite the downgrades and the net losses, Edgewell's historical dividend data is sending a really strong signal of confidence to its investors. Take a look. They have steadily maintained a 15-cent quarterly dividend per share right through all the turbulence of late 2025 and into 2026. Management is basically proving that even while they're navigating heavy restructuring costs and credit downgrades, they're fully committed to maintaining a predictable baseline of shareholder returns. Furthermore, that $90 million they're spending on restructuring, it isn't just going into a black hole. It is actively funding the creation of a simpler, highly automated, and way more efficient supply chain. For example, they're currently consolidating facilities and building a brand new, highly automated blade manufacturing plant. The expectation is that once these high restructuring costs finally cycle off the books by fiscal 2027, the underlying company will be vastly more profitable. This entire strategy is anchored by the perspective of CEO Rod Little. He noted that shedding the feminine care business is a pivotal step, allowing them to focus their resources entirely on shave, sun, skincare, and grooming. By shrinking the company's footprint and shedding some dead weight, they believe they're actually making the core business much stronger, more agile, and highly durable in the face of intense retail competition. Which leaves us with the ultimate question, doesn't it? Will this leaner, hyper-focused portfolio be enough? Edgewell has made the hard choices. They've taken the financial hits, and they've laid out the roadmap. Now, it literally all comes down to execution. Can they leverage their core brands to outpace giants like Procter & Gamble and Unilever and eventually win back the confidence of the credit agencies? It's this really fascinating tension between short-term pain and long-term strategic gain, and it makes Edgewell a compelling story to watch in the coming quarters. Thanks so much for joining me on This Explainer, and keep learning.